The market is pricing in cuts to wholesale rates this year, but are we there yet?
Central banks and government finance specialists globally have been off the card in terms of what they've predicted and how they've reacted to it. And they've also been very defensive. So the interest rate curve is now telling us perhaps not to expect Fed rate cuts until the very end of this year, if there are coming at all.
It's Monday, the 22nd of April, and you're watching Markets with Madison. Central banks in the developed world are in a race to cut rates, if their inflation price figures allow. Switzerland has already done it, and the ECB may move in June. But the US Federal Reserve has already pared back expectations this year, and like New Zealand, its domestic price increases are proving hard to budge. Labour markets are still running hot, with complications from migration, leading more forecasters in Australia to now say cuts may not be seen there until 2025. All this uncertainty has already had implications for investors. Greg Fleming from Salt Funds Management has given us a first copy of his research report that looks at all of this. It's called The Bumpy Ride to 2%. Hey Greg, thank you so much for sharing this one with us.
Pleasure, Madison. Hey, nice to see you.
You too. Let's start with the interest rate curves. In this game, there's what the stats tell us, there's what central bankers tell us, and then there's what the market tells us. So what are the major rate curves saying right now?
Well, they're certainly a lot less blithe in expecting rate cuts than they were at the end of last year. But, you can't blame them for that because they've had a different message poured into the area in the last 6 weeks or so. I think the first thing to say is markets have become really transfixed by central bank signaling. Now, it's probably in the long run not so healthy, but that's the situation we're in now because of the scale of central bank liquidity engineering that we've seen for at least 3 years and perhaps longer. So the interest rate curve is now telling us perhaps not to expect Fed rate cuts until the very end of this year, if there are coming at all. Previously, we'd been seeing 6 to 7 cuts being priced for the end of this year, which would be a rapid and radical easing, back to a more normal policy rate level. But the US economy has just gone from strength to strength. Price pressures are still remaining sticky there. Full employment is in place, which would have needed to soften somewhat. There are many positives in the US that have kind of offset that traditional relationship between activity and monetary policy tightness. And so the latest Fed messages have been, hang on, hold your horses. We can wait a few more months before we need to do anything at all.
This then begs the question that I think not enough people are asking, Greg. Are cuts actually coming this year or not?
Yeah, well, it remains to be seen. I think you can say on balance, yes, that there will be at least one symbolic cut, potentially 2 cuts. Now, in the US, I think that's kind of important because there is this election coming up in November. One of the candidates in that election has a very bad relationship with Jay Powell, the governor of the Federal Reserve, that goes back years, where he was threatening to sack him, Trump, during the last term he had in power. So there's probably no love lost. Powell is very professional and diplomatic, but I suspect he doesn't want to foresee another 4 years under Mr. Donald Trump. Now, for whatever reason, the Fed tries to maintain absolute political neutrality. So, some commentators have said if they are going to cut, it actually may need to be sooner to have an impact, because if they cut pre-election, everyone will suspect that it's a signaling mechanism that they want Biden to stay in power. So this is an unusual dimension to monetary policy setting in the States now, that people are second-guessing how it will affect the election in November.
I'm glad you brought up the US election. I was going to anyway. And focusing on the point of signalling, is there a scenario where all the data says to central banks stay the course with rates at this level, or perhaps even go higher, but the central banks have signalled to a degree and perhaps hiked the requirement for rate cuts soon, and governments need their huge debt repayment bills to drop, so then central banks just cut anyway, because no one can afford them to go higher?
Yeah, I think that's a really good point. I think, first of all, you've got to remember the lead times and lag times of monetary policy. The Fed has been very clear on this right through. They are making monetary policy for early 2025. right now, because that's when its impact will be most keenly felt. So they've already restrained the economy quite dramatically. And now they're thinking, how soon can we take the foot slightly off the brake so that when the natural cycle slows through later next year into 25, it doesn't overslow and move quickly into a deep recession. So they've got to signal that they're aware that there is still a risk that things are not as healthy under the bonnet as they may look if you're looking at the consumer data now. And I think anyone who's been through 2 or 3 decades of watching central banks is accustomed to that. It's just in recent times, some commentators see central banks as acting in real time. You know, if a bad thing happens, central banks act. And I think that's because they've been reacting to crises. They've been easing rapidly when something bad happens. But that's not the typical central bank monetary policy cycle. Normally, it's slow and steady, whether up or down, and it's done with an eye at least 12 months and usually 18 to 24 months into the future. And just remember that what Powell is now saying is we have slow deflation, we have cooled things off from where they were. Now we've got to wonder if next year things will continue to cool or whether they'll re-accelerate. Because if they re-accelerate, they can't take the pedal off the accelerator and put it back onto the brake too quickly, having just reversed direction. So that they are thinking those longer term determinants of where they want the economy to be in 18 months.
There's research out there from some economists, like Dimitri Velatsis from Aurora Macro Research in New York, who suggested on the day of that US CPI data report that came out hotter than expected, that the Fed's current rates are not actually restrictive enough. But you're telling me that you don't agree with that and think the work here is done and is so forward-looking that any recent data doesn't matter anyway.
Yeah, I think there's a heterodox school of thought out there that goes even further than that and says, well, maybe higher rates are actually stimulating the US economy because of the savings level and people receiving higher interest rates on their savings. And in the US, quite a few people do have cash savings. They've been boosted a bit by COVID era stimulus, so they've got more cash than they had before. Those that have been in certificate of deposit style accounts have seen a boost to their incomes. Many of them, because they've got 401ks or IRAs, they might be retired, so they're not living off cash savings. They can consume more. And so that really surprising robustness in consumption in the US, it's got something to do with older people with plenty of spare cash who actually can go shopping and are not particularly sensitive to the interest rate cycle at all. They have no mortgages. You know, a third of the US population base is mortgage free. And so you've got to take those people out of the equation when you're using the central bank interest rate lever to change the demand cycle, because they really don't necessarily feel it. And if things are more buoyant because of that group than other indicators might indicate, they can stay on the current Fed funds rate for a wee bit longer. Whether they need to tighten, I think that's a bit of an outsider call at the moment because they've got such a strong currency. You know, all their input prices are lower than they were traditionally. Um, Energy prices are higher, but they're not restrictively high. They're not at $120 a barrel as they were a couple of years back. So at the moment, I think they've got things into quite a good place. And the trouble is that the markets don't reward an equilibrium state. They want a direction of movement. Markets hate the fact that things might not change for 6 months. And so they're kind of jostling and agitating and saying, let's have an easing, or let's have some clarity about when that easing will come. It may be that they can afford to stay on hold for some months.
Yeah, this reminds me of what the chief executive of National Australia Bank said to me the other week. He said, we talk about rates too much. They actually don't matter for a significant portion of the population. And those wealthy savers you talk about, there's a lot of them in New Zealand. Do you see that same risk then being applied to New Zealand and even Australia to some degree?
Yeah, I think here we've got a slightly different problem because we've often made our money through, say, the housing market. And we have restrictions on when we can access KiwiSaver, for example. So yes, we do have a large part of the population that isn't so sensitive to the interest rate cycle. But maybe that part of the population, they were really suffering during the low term deposit rate era. They had quite cramped disposable incomes at that time. Um, I don't think our central bank takes those people so much into account because they're not high spenders here. Our retirees tend to be lower spenders compared to, say, US retirees, who are some of the wealthiest people in the world. So here, it's more a question of the burden, and it's a horrific burden that the middle-aged people who are, working as many hours as they can to service their mortgages because their capital asset in their house is all their wealth, and they need to get the deal on that retired as quickly as possible before retirement day inevitably looms, and they're forced into an unfortunate need to, say, liquidate property that they don't want to leave, things like that. So I think because we've saved historically much more via houses than via securities, we're more vulnerable than the US or even the European consumer.
Which only enforces the point that easing needs to occur here sooner rather than later, right?
Yeah, I mean, as a country, governments and people alike, we've kind of made a collective choice that we're comfortable with accumulating money mainly through the tax-free asset, residential property. People all around the world put money into the tax-free asset. There's no mystery in why they do that. And you see it in other new assets that have emerged onto the horizon in recent years. One of the reasons they're so attractive because they're outside the tax net. You have to be kind of honest about acknowledging that. So governments and central banks have to be very aware that people's sensitivity is highest in the area where they've concentrated their savings. And in New Zealand, it is definitely property. And unfortunately, that is largely debt financed here for people who have got into the market in the last decade. So yes, people are sensitive. Then there was the kind of bonanza borrowing period in COVID, where they were encouraged to borrow even more and did so. And yes, there's this sort of hangover from that. There's no doubt about it, which is, I think, why both the central bank and the government at the moment are really on a tightrope about how much they let people take out from their earnings and how much they need to retain in terms of funding what they're continuing to fund.
On the asset of securities, when will equity markets care about any of this? Because they've shown so far this year that they don't.
Yeah. Remember that investment is always a choice between multiple possible assets. So it's equities or bonds very often, or it's equity or real assets very often, whether that be commodities or property or infrastructure. So equities are strong because bonds are unattractive. And even at the higher yields that they're now paying, they're still unattractive. And a lot of that has got to do with some concern about inflation persisting for longer because of these structural changes that have happened in the composition of inflation. But a lot of it's got to do with the debt levels of the issuing governments. You get a lot of varying commentary on how an auction might be likely to fail when the government auctions off a new tranche of bonds. On occasion, investors are just not interested and can walk away from it. Some of the traditional Asian buyers of Western government bonds have been less keen on picking them up in the last year or so. You can overstate that because when rates are very high, there'll always be a buyer at some price. But longer term, it's easier to see growth out of your equity holdings. You don't see real growth in your bond holdings. The best you can see is value preservation.
If we can finish on the topic of investor behaviour, you raised a point in your research report that I thought was incredibly interesting and important. That with all of this, I guess we could call it monetary policy nonsense, because they haven't been right a lot in this cycle. And you said that that's forced more investors to take matters into their own hands, that the amount of funds flowing to these still unproven areas of the market, like AI stocks like Nvidia, and you called this a retail preference for quasi-trading behaviour. Can you explain that trend to me? Is it a threat? And if so, to who?
Yes, it's definitely emerged since COVID. I mean, there were some of the origins of it a wee bit earlier, but retail investors now, if they have spare cash to play with, a larger and larger segment of them are going online and doing it themselves. Partly because they think that they are kind of more sharp and savvy to new things, that they've got eyes to new tech developments, which can be true. They're very highly informed now on social media. The problem is they can also engage in crowding and get on the bandwagon sometimes a little bit too late. But they definitely don't trust the technocrats to manage the big cycle in their interests anymore. And I think that's a crucial change. It's politically relevant. It's relevant in economic policy. That the central banks and government finance specialists globally have been off the card in terms of what they've predicted and how they've reacted to it. And they've also been very defensive. There's an orthodoxy that none of them will question. And it's basically just trust us, we know what we're doing. We know what's best. Now, that doesn't play with the younger demographic anymore. Young people don't like being told that, and now they've got options. So, as a professional investment manager, you can encourage them to access new options, but you have to advise them that the characteristics need a lot of deep digging. Don't just invest in something because it looks good now. It might have flaws in it structurally that can emerge later. It's not to try and put people off things, but it's to say a conventional asset does have guaranteed backing in some form or other. An unconventional asset, you have to look at what the real cash flows backing that asset are. And if it's nothing more than popularity in the moment, then you've got to say, I'm going to be riding essentially a sentiment momentum bandwagon. And so be careful if you're doing that. But if it's reflecting structural transformation, which is true and radical and real, it's no reason not to take some of your portfolio into your own hands. If it's money you can afford to lose and you don't need access to it within the next year or two, great.
So it's a threat to portfolio managers and active investment management firms as we know them. It's a threat to central banks and their credibility. And it's also a threat to the investors that are taking matters into their own hands because in many cases they don't know what they're doing.
Yeah, yeah. I mean, we're kind of in those old maps that have a part of the sea where it said, "Here be monsters," here be dragons, and they draw some leviathan that looked horrifying. I mean, there's an element of that. We're going out and looking for new islands and new El Dorado sources of wealth, and there are dragons out there too. I think it's crucial to know that you're never protected, even when you think you are, by government agencies. Government has a record of allowing things to happen and then kind of being the ambulance at the bottom of the cliff, if you're lucky, rather than acting preemptively. So you can't take security in the regulators. I think as an asset manager, you're kind of, in a way, sometimes stuck between rock and hard place because regulators do encourage or force asset managers to hold certain assets which are not necessarily in the investor's best interest or in the end customer's best interest, but regulation makes them go there. On the other hand, are the escapee or refugee investors who don't need to use those structures, and they can go off into very wild country and beyond the reach of professional advice. So we've got to kind of still establish that we are worth listening to, even if we don't always have the hottest or sexiest asset on the book. It's still worth speaking to a qualified advisor or a shop that can tell you the whole picture of what's likely to happen in the world in the next year or two.
This is such an interesting conversation. I just wanted to finish on one point, Greg. You headlined this research report that you emailed to me, The Bumpy Road to 2% being the midpoint target range of inflation. But what makes you think that they're going to go all the way to 2? Won't they celebrate when it hits 3?
Well, it's interesting. Yes, I mean, they could do that. However, if they've got a formal 2% target, they're kind of failing if they don't reach it. The other thing is if they were to adjust the targets upward just to match where easily achievable inflation is, then they hit their bond markets quite badly because bond markets have to pay a real yield above inflation. If inflation is persistently, for the life of the longer bonds, going to be not 2, but 3 or 3.5, then the amount a government has to pay to borrow in the bond markets is commensurately higher, which means higher taxes, which means more restrictive government spending. So the treasuries and the central banks, who are independent from one another, have to kind of stop working at cross purposes. They've been working at cross purposes for ages. And they do have to say, if we're going to accept higher inflation for longer, that has other consequences we'll need to look at on the fiscal side, whether that be tax cuts or more austerity style programs, which you'll start seeing around the world. And just to wrap up on the election again, I was amazed. In Bloomberg overnight, the headline came in, some senior Trump advisors are advising a flat tax rate in the US of 17%. So now we're heading back towards the Roger Douglas, proposals from the late 80s that caused all that problem for David Lange. I don't know if Trump would have an open ear to this, but it sounds like the sort of thing that he could be open to. If there's a flat tax rate at that level, given the US debt situation, there's going to be ructions in the bond market of the sort that Liz Truss and Kwasi Kwarteng saw in 2022. They made the mistake of cutting taxes without cutting government expenditure first. And, we're not doing that here, thank goodness. But yeah, these radical proposals are flying around largely because people are so squeezed in their after-tax income. And there's a constituency for them for that reason.
Well, I'm glad I'm not one of the people making any of those decisions. We just get to talk about it, Greg. Thank you so much for your time. I appreciate your thoughts always.
It was a pleasure. Thanks, Mars.
Greg has such a great lens on things. He's able to go super deep into the daily data, but also assess everything from such a macro point of view. He tells me it's because he's actually a historian who loves to read. I want to hear your thoughts on this topic. Are you preempting rate cuts this year, or are you more pessimistic? Let me know. Now go put your money to work. Thanks for watching Markets with Madison, the New Zealand Herald show for interested investors. If you want to stay up to date with financial markets, click the subscribe button below and you can watch our other episodes here. Stay up to date with all the business news and numbers as they land on nzherald.co.nz.